We're going to start the panel discussion. I would like to call upon Ms. Anna Tutova, who's a moderator for Coins Telegram, Harun Rashid from Space IZ, Mr. Kumar, Gaurav, founder and CEO of Cashaa, and Mr. Aman, Sanduja, founder of Moving. Thank you.
Hello, everybody. So today we are having a panel on DeFi and risking DeFi and the trends in 2021. My name is Anna Tutova. Let me introduce more myself. I'm CEO of Coins Telegram, and we have a group of companies. We have crypto fund, news media, and PR agencies. So we help different blockchain crypto companies in the industry with promotion, with PR into financial, business, crypto media like Forbes, Entrepreneur, Cointelegraph, and so on. With regional PR, we work with a lot with influencers, do social media campaigns. So basically help to grow this ecosystem. And I would like each of the speakers to introduce themselves and tell about your companies and what you do. So let's start with Aman.
Thank you very much for having me. My name is Aman Sanduja. It's been 4 years in the crypto space. Good to see everyone in the physical conference. So what we're building at Moving is a social investing platform. Think of it like a Facebook for crypto investors on the Web3, where you can invest along with your friends and explore various other farm deals with influencers and friends, and invest together in confidence, because Telegram has a lot of noise and complexity, and we wanted to address this problem. Thank you. So excited to share the panel with Gaurav and I forgot his name. Harun. Thank you.
Hello everyone, my name is Kumar, Gaurav. I'm a founder and CEO of a company called Cashaa. We are basically B2B banking platform. And our relation with crypto is that we provide banking services to crypto companies. Not only crypto, we are also expanding to FX. But in crypto, we have a big market share. If you talk about our client list, it starts anywhere from Binance to Nexo to it's Paxful, so or Polygon, Chainlink, any kind of decentralized, centralized, peer-to-peer systems, centralized exchanges. So we are providing banking services to all of them. In 2021, we are now getting into B2C banking, where we are looking to also give accounts to traders who are having difficulty to trade with the regular traditional banks, or have problems in P2P trading. In fact, in India, we are globally, our business banking services is globally, but in India, we are starting first this experiment with B2C, where we are also setting up physical bank branches where our users can go and do the transactions. So that's more about Cashaa. I think we will talk more about B2C, and you will hear more news about us as we will become also useful for the regular crypto community.
Thank you, Kumar. My name is Harun Rashid. I'm the founder of Spaces. We are the first decentralized economic system. And what we do is we offer an alternative to the traditional app-based systems. We are trying to make a fairer and more equitable system that allows individuals who participate to become stakeholders rather than just another customer. We're literally just trying to raise awareness at the moment, but we've been working in the crypto space for the last few years. I also have a background in cybersecurity. So we're trying to implement the both elements into providing a secure and fair system for all.
Thank you for introduction, and I would like to start with our discussion, and I would like the speakers to share their experience in yield farming. And the first question, are you currently invested into any liquidity pools, and how do you find out new yield farming opportunities? So let's start with you, Harun.
Sorry, say that again?
Tell about your personal experience. Are you currently invested into any liquidity pools, and did you do any yield farming?
So at the moment, I'm not invested in any liquidity pools. But yes, we have done yield farming in the past. Now, when we look at yield farming, we look at really our own risk appetite. And that's how we decide where we want to be. Now, when we position ourselves, the idea is to look at our portfolio, to decide what percentage of our portfolio we want to hold in certain products. Now, again, one of the most important things is the personal risk profile we have as an individual. Now, if you are high risk, your kind of portfolio will be very different to if you are a low to medium risk. But let's be fair, everybody who participates in crypto is high risk, right? But high risk in itself doesn't mean you just throw your money away. It means looking individually at each product or each project that you're investing in and weighing the merits of it. So, and that's what we try and do when we do farming in that way.
Thank you. What about you, Kumar?
Can you again repeat what's...
Yeah, are you invested currently in any liquidity pools?
Me personally?
Yes.
No, I am not invested in any liquidity pool.
Have you tried any ones? Like, how do you see this? Is this seen?
No, see, right now you have a lot of things. If you ask me personally, Binance Smart Chain have done a very incredible job in this whole liquidity pool and yield farming. Because of their trust wallet integration, it becomes like very, very easy. I don't know how many people are here who are actually using the trust wallet? Okay, and how many are you MetaMask user? Okay. And how many of you have invested in or participated in liquidity pool through MetaMask? Okay, so I think you guys have to talk around and mingle with them, because there's a lot of people in the room who are using MetaMask, but not everyone is participating through. So I think that's the problem here. So we have an opportunity, we have incredible returns, we have so much stuff going on, but even we have access to these tools, we exactly don't know how to participate it, right? And the same is with the Trust Wallet. I think in a Trust Wallet, if you are using the Android, you have a much easier option. You can just move your coins. It doesn't matter, you have Cake, you have C98. I'm just taking some of the names which have the bigger liquidity pool. And you can just directly through your mobile app, you can participate in these pools, and you start getting advantage of these volatile crypto market, which definitely right now looks very, very good, and I think it's a very best time to be in the crypto. I'm not vouching for how long, but I think it's a time when we have to learn, we have to experiment, and we have to invest. And yeah, so I will say that those people who don't have a Trust Wallet on MetaMask, download it. It will make your life more easier to understand how to participate in these liquidity pool, how to just buy some coins. I think just to experiment, you can just have a Trust Wallet and some Cake into it, and you will start your journey.
Thank you. What about you, Anam?
So for me, I'm a hardcore trader right after the college days, and I'm trading into the stock market as well. So passive income actually makes a lot more money if you look at from the compounding principles. And active trading gives you, of course, an adrenaline rush to make some more money on day-to-day basis. So it is definitely one of the best technology where you can start earning passive income if that fund is of not immediate use for you. So I usually look at from pools.fi, some from My Connect, YouTube channels, and then there is Versant as well. So there you explore different pools and compare the APY and APR percentages and stake your coins, and then you can start earning a passive income. I think it's the best mechanism in the blockchain, because it is actually allowing you to become the CEO of your own bank. Your bank is a wallet, and it gives you an interest on top of it, which is through these pools and all. So definitely a wonderful thing in this DeFi ecosystem, and there are various pools where I have invested in, and usually the criteria remains as the history, APY, APR percentage, and different other things.
So Aman, why not you tell then people some of the good pools which you invested and made you in some incredible returns? I think everyone want to know that, right?
I think we should.
That's the point here.
We should follow first few pulls from you. What are the few?
I already told, like I bought bunch of cakes and I think that generates
I am afraid of cakes.
Oh, you are afraid? No, I love cakes. Come on, guys. In COVID, I think we all got like some extra pounds. So having some extra cake doesn't hurt anymore.
No, I am more into curves and ribbons than cakes.
Oh, sexy.
So, I'm more into curves and ribbons than cakes. Cakes are for babies.
Yeah.
No, there was a baby cake swap, so that's what I'm saying.
No.
Yeah, so we touched a bit a question of returns on the yield farming and APR, and a lot of protocols offer just like thousands of percent of return on your staking. So when do you think this APR race will stop? What do you think, Kumar?
I didn't understand the question.
So different protocols, especially new ones.
Your voice is echoing here. What you?
APR race will stop. There every other protocol, every other APR race kab khatam ho?
No, why we want to end that race? That's incredible. That's what making us all of happy, right?
Well, I don't want to end this race, but as we see, like with the growth of the industry and as well, like when protocols mature, the APR becomes less. So how do you see the involvement of all this?
I think that's so. See, when we talk about APR, and sometimes we talk about incredibly high APR, right? 1,000%, 2,000%, 3,000%, right? I think Aman, you know more. Or, it doesn't make any sense. And if you also look at to some of these very, very high APR, there's not enough liquidity. So I think this is a race. I think right now we are in a bull market. We don't have to make a sense of a lot of things that are what I have learned in the last 5 years. But I think as the market will mature, the people will mature, they will start differentiating between what's more solid, where is the actual technologies, where is the actual companies are, where is the actual logic to generate, because anyone cannot give just the return out of thin air, right? They have to have a business model, and that business model need to generate some revenue. And that's when we can talk about APR or APY or whatever it is. But sometimes when you see some of these things, it doesn't make sense. So for us, we did also a fair analysis, and currently, because I mentioned we are not into B2C space, but we are getting into there slowly. So we built the product and we saw that, okay, what actually is driving these APR? And one of the reasons, one of the main factors of these high APR is actually the volatility of crypto market, correct?
Absolutely.
So this is what actually generating. So if a company have an algorithm to just trade, if you, let's forget about general DeFi and high APR. If you are an active trader in a market, and if you see the volatility, I think on any given day today, the volatility even in Bitcoin is anywhere between 1% to 5%. Every day. So, which means that if you combine this, you are talking about if a daily trading volatility we also combining for a year, we are talking roughly just in Bitcoin, if we take 2%, roughly 700%, making like, you are just making 2% every day. So what some of the DeFi protocol they are doing, they are actually taking this liquidity and doing the same. And that makes sense. Up to that, I can understand. And that's something which I explain. And so what we are releasing, we are also releasing a product where we are giving people very straight. It's not that attractive, but it's like, okay, you know, you are participating in our liquidity pool and you are getting, let's say, every month based on your amount, anywhere between 2% to 5% monthly revenue, which goes in a year 60%. It's not crazy like having 300% or 400%, but it's 60% which make more sense to me, which we think that as an institution we can commit, we can stay on our commitment and continue these kind of APR even when there is a bear market.
And I would like to ask a question, Harun. So what does the ideal balance between the risk reward in DeFi should look like?
So what is the balance?
between risk and reward in DeFi protocols?
Right. I think this goes back to what I said at the beginning. Risk and reward is based on the individual, right? And each individual has to decide what their kind of risk reward ratio is, right? So if you're a very risky person, you'll be looking for very high rewards. Now in this market, obviously there are, like you said, thousands of percents available, but equally you need to balance the portfolio that you have. So if you're going to go ahead and invest in, very high risk, high reward products, let's call them, then you need to actually balance yourself by having the lower risk, the lower, and maybe obviously the lower reward. So it's all about balance. You can't, you can't go from one extreme to the other. I think, and that's what we kind of preach, is that balance is the most important thing, whether that's in life, but in crypto especially, because going high risk, you are at the mercy of the markets. You're potentially wiping yourself out. So risk reward is individual, but at the same time, it's about understanding what it is that you want from the market.
Thanks. And actually, as we see, DeFi is in very early stage, and many yield farmers have issues with like impermanent loss, rug pulls, asset price drops. So I would like to ask a question, Aman. What is your opinion? How should people manage their risk in DeFi?
See, well, this industry has a beauty because of speculation and of the new protocols coming out of the market, and new people wanted to participate. When I entered into the crypto market, the market cap was less than $5-10 billion. And we collectively have seen growing to about 2.1, 2.2, 2.3 trillion dollars as well. And with this, as more coins start coming out of the market, all those who are not active traders, they started looking for passive income. For passive income, we had the DeFi and the pools, liquidity pools. From there, this money which goes into a smart contracts gets lended to institutions, or the high beta traders actually take that money on a certain percentage and gives you a return basis that which compounds to a user. So for me, I mean, if you are personally asking me, my portfolio composition usually revolves around largely into the blue chips of crypto, which are Bitcoin, Ethereums, and top 10 coins. And if I am trading, I usually book my profits into BTC, which I convert basis the cycles in a stable coin. So the risk reward gets balanced. And if you're looking from buying point of view, it's always comes out to be a dollar cost average model, where you buy it on the different prices rather than just putting all the money into one single price. Like if it's $57,000, no, I am very confirmed that it will go to $100,000. I am selling one particular asset and converting into it. So second is, like I always tell people, that in this market you will always cry and you will always feel happy. Why you will cry? Because you have seen $30,000 and you have not bought, so you're crying. And you have now seen $57,000 and you're not booking profit. Tomorrow it will reach out to again $45,000, then you will again feel bad. But over a period of time, if you look at how this market has evolved from less than $10,000 to about $60,000, $61,000, and the whole market has evolved in such a way that in India specifically, if you talk about, there are about 25 million crypto investors globally. You have 100 million plus. So it's the beauty of this industry, and specifically from my point of view, I mean, at this point in time, I have liquidated most of my positions in stable coins, and I'm just waiting for some correction. I don't know when it will happen, but on the safer side, I've booked my profits and put it on the stable coins. Thank you.
So what proportion of the portfolio should be in stable coins in your opinion?
Well, it totally depends. I mean, if you are keeping stable coin just in a wallet and you don't want to earn a passive income, then it should be somewhere between 25 to 30%. But if you are using it for a passive income in the liquidity pools, it can go higher about to 45, 50% as well, including if you're investing in top 10 coins and top 15 coins, because ultimately part of the portfolio is giving you passive returns, and part of the portfolio you are heavily invested in the market, which is, as the market appreciates, you get your money as well.
Thank you. And next question I would like to discuss is security of these DeFi protocols. And not many projects conduct quality audits, and even if projects are audited like by big security audit companies well known in the industry like Certic, Haken or some others, they're still hacked. So what should be done with this, and is it a real prevent for a lot of investors to enter this industry? What do you think, Kumar?
Kumar.
Security. What I say? I think if we are talking about DeFi, I think DeFi is still not a stage where we can actually say, yes, it's a decentralized finance. But for me, the best example of still the decentralized finance is Bitcoin. Not these bunch of new coins coming on the name of decentralized finance. I still believe that the Bitcoin is the biggest innovation which happened in decentralized finance. Maybe a lot of people don't agree with me, but that's my one coin which is completely decentralized. I control it. No government can confiscate me. When I started from Monte Carlo, came to Dubai, all my funds traveled with me. I think that's the perfect example of a decentralized finance. And the best part is that it's secure. It's in my wallet. I own the keys. When you participate in these liquidity pools or in these many different DeFi protocol, high risk, high earn reward, I think many people even don't realize that they don't have hold of their coins anymore. It's just not you, and that's why maybe we can wrap it around that it's a wonderful technology where you have this participation through the wallet. But when you participate in liquidity pool, the liquidity pool get access to this. And yes, you can get back it from liquidity pool, but that's not the case 100%. We have seen Uniswap banning many coins. If it is, nobody banned me to stop receiving me Bitcoin so far. So I think there is a lot of knowledge, lot of innovation is still required there. There is a lot of crap which is being sold in the market on the name of DeFi. I think we all have to educate ourselves and then really choose what is actual DeFi and how you manage your security. One thing in a crypto is a baseline. If you don't hold the key, and if it is not something which is solid, regulated investment company or have some kind of regulation, you are not at a high risk, you are at ultra high risk. And this, it's just the day have to come when you wake up and, okay, another Mt. Gox or another DeFi hack. It just can happen anytime because you don't control it.
Yeah.
So I'll just take 30 seconds. So on top of what he has said, I think the question was on the security part. So think of smart contract as your own bank, right? How do you do your research when you're depositing a money into your bank? You always see the legacy of the bank, which regulation, what all customers, top line, bottom line, different other things. But this is not possible in the case of smart contract because at times there are fabricated AUMs which are being shared amongst the different smart contracts as well. So what you do is you usually look at which company has done an audit for this particular smart contract, and if you have coders, all these smart contracts are public in nature, you can go line by line, and when you are evaluating which company has done an audit for this smart contract, what are the risk parameters they have taken into an account. All these information at times are public. You can ask for the information from the protocol as well while you are evaluating if in case the fund size is of large quantum. So these are some of the things, and like Kumar said, if your private key is not in your control, then of course this is not a real DeFi investment which you are making. But definitely when you are looking at the security aspect, the company who is auditing the smart contract, their legacy plays an important role, and of course the line of codes which they have written. So yeah, that's what I wanted to add.
No, I think both are correct, but the one thing we also need to bear in mind is when you're looking at somebody who's audited, you need to look at the auditor as well. Now, if the auditor has no experience of previously having audited something or audited something in the past and it's failed. That will give you a good indication of the quality of the audit. Because security in itself, these DeFi projects are code. Code is written by human beings, and human beings are fallible. So there's generally, in my experience, there's always a problem in the code, and it's a question of finding it. Now, you might not be able to find it, the auditors may not be able to find it, but somebody out there will find it. And if you're seeing these really high returns, you have to understand there is a very high risk that there will be a problem later on down the line. But as long as you understand that and manage that, you can invest as you see.
Thank you. And so we discussed a lot of different risk factors, but still we see somehow the interest from the side of institutional investors into entering DeFi space. So how do you see the future of DeFi yield farming, and what will be the role of institutional investors in it? What's your opinion, Aman?
I think I'll ask Kumar to go first. The question is the future of yield farming, right?
Yeah, the future of DeFi yield farming and the role of institutional investors in it.
The master stroke first. The future of yield farming in DeFi.
Future of yield farming. Why? I think we just started it, so there is a lot of things still need to happen. I don't know what it will be called. I think it's just, if we put into a simple market term, it's about generating wealth. Let's very simplify. Obviously, we have this fancy term called yield farming or high APY, APR. I think when it talks about crypto, the passive income concept, at least for the retail investors, have started in 2021. Before 2021, we were not talking about having your Bitcoin generating interest. Maybe in early 2020 it was there, at least for the common masses, but now it's becoming very, very common. So let me ask you, like, how many of you actually generate profit on your Bitcoins just by keeping it, not trading?
I think the question on top of it should be in every cycle.
Yeah, so only 5 people sitting in the room does that. So I think we have to catch up a lot. I think yesterday we as a Cashaa, for business users, obviously we were doing this for a long time, because being exchanges, our customers, liquidity providers, big OT6, we always have the margin options, we do the margin trades, we take calls, and we generate income on that. But it was so far only for the businesses who were banking with us. But now yesterday we also released the product where if you are a retail investor, you just open a Cashaa account, you deposit your Bitcoins or Ether or Tether, and then you start generating, I think in a year it's somewhere between 6% to 14%, but in that coin. It's not as attractive as we hear in the yield farming, 100%, 200%, 500%, but this is something which is can be actually been generated. So I think as the market will mature and the people will understand where is a long-term investment, where it makes sense, you will see more consolidation, and I think all these concepts of crazy APR will come down. You will have a more legit company. You have some of our customers like Nexo doing an incredible job. You open a Nexo wallet, you deposit a bunch of Bitcoins and stuff, and you start generating. And there is an actual business model, and being a banker, we have evaluated these models for last 2-3 years, and now we see that there is enough appetite that the depositor's deposit can still stay safe and generate yield. And I think more and more companies will start doing it, and then one day we will have everyone in this room having a Bitcoin in their wallet or USDT in their wallet and just generating a little profit for them. Like regular banks, I don't know, because we are in Abu Dhabi, we are in Dubai, so here still you have like an annual interest of roughly 1.5%, 2%, maybe 2.5%. If you are in Europe, it's actually crazy. It's a minus. So it really does not make sense to now keep any money in fiat instead of having in a stable coins and then generate, let's say, 8%, 10% annual profit. Because, okay, now I'm not talking about those crazy numbers, so don't get disappointed, but this is something which is ultra safe you are talking about. putting these funds with the regulated institution, not with just putting on some bunch of codes and then let the magic happen, or let the fortune play the role.
So how many of you want to keep your money in bank versus in your crypto wallets? How many of you want to keep your money in a bank? Ultimately, maybe 5, 7, 10 years down the line. How many of you actually wanted to keep it in crypto wallet? Oh, that's the future. So if as more people start growing in the market, the network effect will come in. So smart contracts work actually the replica of the banks, which is why we call it as an ecosystem of decentralized finance. And as more and more money start getting locked in, this money has to go out as well. So think of it like a crop rotation. So banks take the money at a cheaper price from the retail audience or retail customers and give it to an institution at a higher percentage. So same is happening in the smart contract. You are depositing, somebody who is borrowing it, therefore there is a spread between APY, APR, compounding, interest, cycles, all these things happen. So if the demand start increasing it, right, then the more lock-in in the smart contract will come in. More lock-in means more yield out. More yield out means more institutions want to avail that capital, more institutions, more retail customers. So this whole cycle will actually act as a growth loop. And when this growth loop will become possibly bigger than the banking infrastructure in the world, I think that will be the time when we look at the past and see that we have actually disrupted the present while talking about from the past and the future.
But no, Aman, that's not how the banking or the economy work. For an economy to work, to money to work, you also have a demand and supply and a commerce to happen.
Absolutely.
Not just the people putting money and then imagining, expecting that it's going to grow. That's not how the economy works. We have e-commerce, we have businesses around.
Absolutely, absolutely.
So what happens over the time, which I believe is that maybe the crypto also have to become a mainstream where it can be used as the way of commerce. Because end of the day, money is just the value transfer. It's not a value in itself. My dollars or my Bitcoin never make me feel better when I'm hungry or I'm thirsty.
El Salvador makes you the same thing happens, right? You can buy your burger from a cryptocurrency.
Wonderful, and that's what we are talking about. That's where it have to grow, and the thing is that it already started. So yes, today we have a small country who is starting it into the e-commerce and in the general economy. And I think over the time we were hearing about Brazil going into the same road. And I think we have hundreds or more countries because in crypto we keep hearing about this volatility. Oh, this is volatile. I can lose 10% tomorrow. I can lose 20% tomorrow. Last year, our institution have made 12% just in the volatility adjustment between pound and US dollar. 12%. And we are talking about world's two strong currency, US dollar and Great British Pound. So imagine there are hundreds of more countries. Yes, we are sitting in UAE, very stable economy. The currency is backed with the US dollar, so we don't see those volatility. But there are more than 100 countries where their own currency is more volatile than crypto itself. I think it makes more sense for them over the time to move their economy into crypto. And then we will start seeing bigger effect. And then when this effect will start, it will be not something which will go in a step fashion. It can go in an exponential way. And I think that's all what we are in here for. Yeah.
Thank you, and share your thoughts with us, Harun.
Well, for me, I see institutional involvement in DeFi a long way off. Simply because it's far too risky. These institutions have to answer to the shareholders, to the regulators, to all these authorities, whichever jurisdiction they're in. And right now there is a very big push against institutions getting involved in crypto. Now, that's going to change, but it's going to change slowly. There is no, and I think you kind of put it best, it's about de-risking. Now, the only way institutions are going to get involved is de-risking the DeFi protocols or products that we have. Now, if you de-risk those, what does that mean? That means the reward is less, right? So again, Kumar is right. You won't get the 1,000% or whatever rewards you have now. You will get something more in line with what's maybe better than what you have in markets at the moment. But again, it will involve a lot of de-risking and a lot of work with regulators to show that what's being done is actually not putting the entire financial system at risk.
I think we are running out of time, so thanks to all the speakers for interesting discussion.
Thank you.
Thank you. Thank you, everyone.
Thank you so much.